Good morning, everybody. Welcome to the Locke Your Success Options Trading for Income Weekly Update for September 22nd, 2014. Before we get going, I'd like to remind you that the presentation is for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware the risk of loss in trading options can be substantial, so please be aware of all your risks prior to placing any trades. And also, please note that we do use hypothetical computer simulated trades and results in the presentation, and actual results may vary. If you're watching this on YouTube or some other venue, come on over to LockeInYourSuccess.com. Check out our programs, M3 Bearish Butterfly ROCK, M21 Group Coaching and Trading Triangle programs. And also join our mailing list, get your free report, 7 Secrets to Becoming a Successful Trader. Sign up for this weekly webinar. Just a notice before we get going. I am going to be doing a presentation at 4 p.m. on Thursday on investor inspiration. Anybody who's interested in viewing that or seeing the recording, you should go to and register. Now, I will put a registration link with the recording here and post it on my blog. Also, if you're on my email list, you should be actually getting an email sometime this week, just letting you know what's happening, and you can go ahead and sign up and register there. So yeah, I'd love to have you register and have you attend. All right, so let's take a look at what's going on in the markets. Last week we were expecting, well, keeping this in the context, right? You got to keep everything that we say here in the context that the markets have been in a state of confusion in general. We've been generally chopping to the upside, but the traders in general don't really have any direction here. So keeping that in mind, we were thinking the markets were going up for the week last week, and that's pretty much what happened in everything except for the Russell. The Russell actually had a reasonable down move. We had, if you look at the Dow, we had the breakout we've been looking for in the Dow, and unfortunately this came a little bit out of context. I was thinking a breakout in the Dow along with some sort of a breakout in the SPX, and also a breakout higher highs in the NASDAQ, which would have held. What we got in the SPX is we just came up right to our resistance point that we've been kind of bouncing off of all along, and we backed off, which tends to spook off which obviously spooked the small caps and sold those off pretty hard on Friday. So that puts this breakout for the Dow, makes it less meaningful. That said, I wouldn't be surprised that, or I would expect this breakout to hold. So kind of what I'm thinking might happen is I know the futures are down this morning. I don't know if they're going to stay down or not, but I would expect the Dow maybe to retrace a little bit more, maybe even test the support level here and then continue higher, which should drag the SPX into a breakout and drag the NASDAQ a little bit higher as well, and at least hopefully hold footing on the Russell. The Russell itself has a support level it's going to want to come down to here at 1140 at least. And that probably is going to happen this morning. If we break that level significantly, we have another level that's fairly significant at 1130. And of course, if that fails, then we have, we're looking at maybe 1180, 1190. So, as of right now, I don't think that's going to happen. I think we're going to hold somewhere between the 1130 and 1140 level, probably at least manage to run sideways, if not higher, along with the other indices. So I'm still thinking higher for the week, even though we may start out a little bit rocky on the markets. Again, though, you can see the confusion in the markets. The Dow's up, the Russell's down, the NASDAQ is kind of like, it's having trouble breaking a resistance level, as is the SPX. So just a lot of confusion in the markets right now, more of the same, chop sideways, unpredictable. So as far as the 50-day moving average crossing below 200 moving average for the first time in a very long time on the Russell, yes, that is for the first time in a long time, and some people do take that as a bearish crossover. And we also have the theory that the Russell usually leads the market down, and people come out of the small caps, they go into the large caps, which are considered to be safer, which is what they're doing. It is definitely a sign of a market reversal. I just don't see it yet in the charts. It certainly may happen. Signals are certainly there. Again, there's a lot of confusion in the market, and that may happen. I mean, the other thing you have to remember is last time we got a 50 to 200-day moving crossover, we had an explosion to the upside in the market. So in the Russell, the whole market went up fairly high. So that in itself isn't necessarily meaning the market's coming down, but it certainly is not a good sign for the markets, for the bulls in the market. All right, so yeah, choppy sideways is usually good for income trades also. However, you want to watch it because choppy sideways also, once it breaks out, can be pretty nasty. So the month that actually happens can certainly be a losing month, so watch out for that, which is why I like to tend to stay in an M3 type of trade. You make money slower. You would have been better off if you were in a very aggressive trade, but in the long run, it's usually safer because you get some pretty strong moves out of these consolidations sometimes. All right, so that's pretty much what I'm thinking on in the markets. Now let's look at the trades. So last week, I was basically saying I was looking to get out of the ROCK trade and not the Bearish Butterfly, but the ROCK trade in the M3 for September. I was willing to take a 5% gain for September because I just didn't like what the market was doing and move on. I was also willing to, if the market forced a rollback in the ROCK trade, we were just going to simply exit the ROCK trade, hopefully to get 10%. But you know, we're okay with whatever we got. So if we take a look at Monday morning on the ROCK trade, we did get that pullback or gap down Monday morning. We looked something like this. This was obviously going to cause me to pull out of our upper butterflies here, and even that wasn't going to correct the delta number here. I was going to have to roll back into cap position, which would have been fine. I could have easily rolled back into cap position or taken this 1140s, rolled it down to 1120. The trade would have done fine. It would have expired. Well, let's see what it would have looked like. So I could have done this. Right, and then pull these off. And roll those back. I'll just show you what we should have done here, holding with the actual guidelines. Would be roll back into something like this. I could have done this. I could have rode the week out and closed it out probably in the $4,800 range. In the meantime, I probably could have, once the market stabilized on Tuesday, I probably could have pulled out some of these wings and maybe raised this up to maybe, probably 5,500, $6,000 or so for a profit in the trade. So could have done that fairly easily with this. Wouldn't have been an issue. However, I know going back into this position, I'm not really going to make a whole lot more money. It would be pretty unlikely. So when the rollback time came, I just simply exited the trade. So if we come to, and we did that, I just did that in the morning. If we come to here, and we look at our reports, end up closing this out at 47.82, which is a little bit less than what I wanted to, but it looks good. So everything was good there. Yeah, I have a settlement for the Russell was 1162 in case anybody didn't know that. If we look at the M3 trade, I basically had the same thing. I was looking for to get it out of it at anything over $2,500. This pullback on the M3 trade, if we take a look at, brought us to about 33.80. It actually pulled us right down into the sweet spot here. And this trade, I could have held. Really no danger here. It just came right down into the sweet spot. With the pullback, we could have rolled this out a little bit more and maybe even expired at the 1162 range. I probably wouldn't have done that unless I took some of this upside risk off. So we could have made our 10% with this trade if we fought it into the market a little bit more. But like I said, I have too much going on right now to have too many trades into expiration, so I went ahead and closed this out for a profit of, again, that was Monday morning, looking at a profit of, let's see here, 33.69, and coming into expiration, we also had the September V Condor, which was just planned to expire. This trade here simply expired right in this range here. And of course, we had really no danger of overrunning any short options if it expired. It was nice and clean into expiration, profit of about 32.80. So if we take a look at how we're doing for the year, now that the September trades are in the books, we got, for September, we had 11.8% on the Bearish Butterfly. We had 11.8 in the Bearish Butterfly for 109.4 for the year on our planned capital. M3, 7.4 for 66.8 for the year on our planned capital, which is a little bit above average. The Bearish Butterfly is a little bit below average now. It was kind of above earlier in the year, but we've been having these repeated months of just kind of 10% profits, which is good. I mean, it's a fantastic return. It's just not going. It may not, depending on how the next 3 months go, it may not hit our target for the year. But it's going to be a very good year for that, regardless. M3 is very likely going to exceed our target because it's already over that, and it's unlikely we're going to have a loss in the fourth quarter. So that's probably going to do very, very well. Our ROCK trade is at 90.3%, which is a little bit below what I would expect. I expect it slightly higher, but again, still doing very, very well for the year. I like to pull 120 out of that. Part of the issue is the market's kept us in M3s and pulling lower profit targets most of the year. And of course, our V-condors on the bottom here, as of the close of September, we got 6.56%, up 18.5, which again is kind of lagging behind normal. But all in all, let's see. On our planned capital, we're looking at a 71.2% return. If you remember right, we're only trading with half of our account, so that's going to give us, corrected for reserve, 35.6% return corrected, and hopefully we're going to get to this 95% level, which is very, very possible. We're certainly within reach of that, and 47% on the entire accounting reserve. So very, very good, very, very good year so far. So we'll see how it pans out going forward. All right, now let's shoot over to our October trades, which again we haven't had a whole lot of market movement, so you're not going to get much for action in October. I don't think we actually did anything. Let me just look at my notes here. Our October, oh yeah, well, we had some trade entries. So if we take a look at the October M3, we'll just kind of show how that's doing. All right, so as of Friday, near the close, this had no adjustments last week. Matter of fact, it's had no adjustments since we actually put it on. The market's just been kind of sitting here. This is up near its profit target, about 42.80. We have minus 35 delta. This is what our position looks like here. So everything's going really, really well in this trade. One of the questions I got regarding via email regarding the M3 is we have a lot of people who have exceeded their profit target or are at the profit target for the month, and they're just kind of asking about, hey, you know, what if I don't want to exit this and stay in? Well, what I can tell you about the M3 is you hold such a flat T+0 line that you don't usually get a whole lot more than 10% profit, but it is possible. Every once in a while you get one of these anomaly cycles where the market just sits, which may be the case here. You know, that being the case, you have a few options. I mean, you could obviously sit in the position the way that it is. As we sit in this position, the market's going to increasingly, in other words, this T+0 line is going to rise. We're going to have increasing price movement risk as time goes along. Realistically, this is the most efficient system, position to sit in because it's going to be your fastest profit and loss growth. However, if you don't want to take on that risk, in other words, you want to start mitigating your risk down, some things you can do here is gradually make some adjustments. So depending on how harsh you want to do it. So if I took these, right, and I brought them back to here, and I took these, and I brought them back to here, right, that cuts my delta down to flat, it cuts my gamma way down, it also cuts my theta like in half. But this puts me in a position like this, where if we superimpose it, I've taken away pretty much all of my price movement risk. So I'm still getting gains. I'm very, very resilient to price movement. as time goes on, if the market stays up or goes higher, I gradually take out this side of my and more or less go more and more into just a bull vertical spread. Market comes down, I just continue with my regular M3 adjustments to the downside. So this would be a very effective thing to do. One of the things you can do to get some really, really good exit pricing is just kind of peel these off a couple at a time. So in other words, you put your prices in, you just kind of let the order sit, especially if the market's kind of flat. You take two off maybe at a time at really, really good pricing until you get moved back into this position, and then you take your next, then you see where you sit and you do a similar move. So you just kind of gradually get out of this at really, really good pricing, make your position size smaller and smaller. You can see just doing this brings our capital level down to 12.5, really brings our risk down, lets us stay in the trade for a little while, give us a little bit more money. So I don't really see anything wrong with doing that or anything in between. Another thing that you could do too, if you want to get rid of the call now, is you can kind of dump the call out and just, if you want to widen out the backside, you can do the same thing. And you can take these out and you can bring them maybe down to, I haven't done this ahead of time, I'm just guessing. Bring this down to something like this, where you're doing something similar. You're taking out your downside risk. This keeps your theta a little bit higher. You have a little bit more upside risk, but not really, because when you have the market shifts, you're going to have a volatility rise, which is going to tend to rise the T+0 line. And as the market goes up, you can just kind of gradually pull out of the upper side of the spread here. And again, you might not want to go quite this drastic, minus 47 delta. You might go maybe plus 3, plus 7 or something. But hopefully you get the idea, where you kind of flatten yourself out a little bit and you go into something like this. Again, very, very resilient to price movement as compared to what we had before. You can see how much flatter the T+0 is on the brown line. And again, if the market goes up to this point, you probably won't make anything else. But if the market sits or comes down, you certainly could do much better here. But again, your theta cuts down. So that's some things I would consider doing, assuming that the market, we're I don't know what's the futures doing now. Assuming we, so now we're only down 5. Again, assuming we're near this price level. If the rut moves way down, would I roll back into a butterfly or roll back and keep a condor configuration? Your butterfly is going to be more resistant to, we're still far enough from expiration, right? So your butterfly is still going to be, it's okay to stay narrow. So I'd be more interested in rolling back into a condor structure closer, if I was closer to expiration. Here I'd probably take, what I do is a partial rollback. If you have more than one butterfly on, you can take half your butterflies back to 1110, depending on how far down the Russell goes. I mean, there's obviously too many variations of what could happen as to how far down the Russell is going to go to do things. But yeah, I wouldn't, if I get, in other words, if I get within 10 points of my short strike or under 1140, I would be in favor of rolling the whole butterfly system back. If I only had a delta problem, but the market hangs up here at 1150, I'd be more interested in doing a condor type of a thing. Or if I was in expiration week or a couple weeks before expiration, I'd be maybe more interested in going and widening the expiration graph. But here I'm perfectly comfortable rolling back. I wouldn't roll back all of it necessarily unless we get a move down to 1130 or lower. But that's what I was thinking there. Lots of variations of what you could do. Of course, to do the rollback, you'd start with the condor roll, the downside to protect your downside, and then you'd move to the upside. So that's what we'll be looking at. Okay, so I'm just kind of looking at the questions here. Why did I choose to slip the shorts between two strikes? Oh, and here? Yeah, well, this is just, all this is the butterfly with 5, 1130, 1140 verticals in here. So that's what that's emulating. So that's just part of the control of the M3. So we had to do a delta correction either on entry or actually on entry. We had to do a delta correction on entry because our regular configuration had too high a delta, and we entered with the split strikes. So no, that doesn't keep my margin lower. It actually brings it up. And oh, you're welcome, David, for answering that. And I also had a couple other questions while I'm here. So let me see here. One was about the November bearish butterfly, which we'll look at in a minute. Expected annual returns of a V condor. I have it at 60, but the reality is it's 30. And explaining that is that you're using double capital because you're always overlapping trades. So I would expect a real full account return on a V condor of, because you have to have double-sized accounts because you're running two trades of 30% most of the time, which on our sheet equals 60%. But that's what I expect on a V condor. Okay, and the last thing was the November bearish butterfly, which we'll talk about when we get to bearish butterfly. Okay, so that's the October M3. We also have an October ROCK trade that was entered, but before we do that, we were already in the V condor and the bearish butterfly. So October bearish butterfly, as of Friday, is doing fantastic, up $7,500. We're only in 1/3 of a position. Of course, if we get too much of a down move, we could get kicked around a little bit, but right now this is looking like this. If we can hold over $5,000 by the end of the week, this will be exited. If not, we go into expiration rules and move forward. My guess is we'll probably be over 5,000 by the end of the week, but you never know. So this is bearish butterfly, no adjustments here whatsoever since the 2nd of September. And we have the V condor for October, which again, no adjustments there. If you look at our T-log, absolutely nothing happening there. I am getting close to doing something with this, though. If the market settles back into the center of the V here, around 11:30, I'll probably end up having to start picking this up because I'm going to start running into theta problems and stuff. But as of right now, no adjustments here. Everything is looking very good. We're up about $1,800, and trade's doing well. We entered an October ROCK trade on Wednesday. I entered it as 11:30. We did the entry test. It came out to enter it as a M3 trade. We entered the 11:30 butterflies with 8 11:30, 11:40 verticals and 2 11:30, 11:50 verticals to get our delta where we wanted it. Of course, the market backed off a little bit during the week, so we're up slightly as of Friday. And this is what the position looks like. This is essentially the same position as our M3 for October. It was just entered a little bit later, and we have some extra verticals in there to help straighten out the T+0 line. This still isn't the best T+0 line. Wouldn't have been a bad idea even maybe to go to 11:20 and flatten it out higher. But again, this is a ROCK trade, and realistically, if we get up into the 1190 level, we're going to be changing this over probably, I'd say almost 100% definitely to a ROCK position, and we're not going to be down enough to worry about. So I'm definitely not worried about the sag up here, which is the difference between entering an actual M3 and a ROCK M3. I don't mind the sag so much because getting down if the market gets up here is not as big of a problem because we're going to enter a highly aggressive position later to get that money back. And that is that. And then of course, we entered one November trade, which was a November V condor. Take a look at that. This is, let's see, I put the 1140 straddle in, put the shorts at 1240 and 1030. This position here is, if I take a T-log, I'll just quickly show that for you guys. And if we take a look at our analyzed graph, looks very much like our, let's put 15, October position, which I don't like, right? I'm virtually in the same strikes as October. Again, it's not something that I like to do. We get a really, really big market movement, then that can cause a problem. The lucky part is, though, that October is actually not in bad shape, so it's still unlikely they'd lose at the same time. So this is our November V Condor, and that is all the trades that we have on for the month. I was asked about taking a look at the November Bearish Butterfly. Again, I don't particularly like buying bearish butterflies at support levels when I think the market might move a lot. So am I crazy about the entry from the potential the market has to make a higher move? No, I'm not crazy about it. However, that being the case, I'm not afraid of it either, because the SPX is not at support, the NDX is not at support, and Dow's a little bit extended. So that being the case, I am not really worried about a bearish butterfly, because I think that that's going to limit the upside movement of the Russell. I mean, it could be a rocky month, but realistically, whatever goes, it should hold under 1,200. That's a 60-point move, I'm thinking, for the month of November. So again, not that concerned. Now, if the SPX and NASDAQ reset themselves, then that's a little bit of more of a concern. But as of right now, I think the upside is kind of limited in the Russell. I do think the markets are going up, but I think it's kind of limited. All right, so let's see here. Will I still turn an M3 into a rock with less than 10 days to expiration? Yes, I will. I will. I don't have a problem with that. Assuming the market's been going up and it meets their entry test criteria, then I'm okay with that. If I had not gotten into an October M3 yet, would I start in November instead of getting an October M3? Yeah, I'd start in November if I didn't do an October yet. The main reason is the October in other words, you put an M3 on 56 days for expiration. At some point in that time, your money comes into your trade, most of the time. It's either early in the trade or late in the trade. Usually when it comes in early in the trade and you stay in, you end up fighting the rest of the month for making no more profits. That being the case, I don't know if I'd enter that, because most people are up 10% or more in the M3 at this point that have entered early. And again, entering this M3 as the rock position, I'm not too concerned about either. But if I had the choice, if I could only do one, I'd probably go for the November M3. Any concerns on it to start the November M3 Friday, 56 days? No concerns on entering the M3 at all for November. I notice you always have the 1 in the option view trade log for current positions. Seems like you shouldn't have to do that since there are no other trades in the account. No, I don't have to do that, but I always do that. It's just a habit. And yes, you'll have to do all the ones to keep the profit and loss accurate if you have other trades in the account. So if you if you have your January trade in with your February trade and you don't mark any ones, and you maybe mark the January trade and don't mark the February trade, sometimes they get intermixed and stuff. So that certainly can be the case. But yeah, I always mark the T-log. It takes 2 seconds. Good habit to be in, so that you can keep track of profits and losses. And do I think the best trade for November is still the M3 configuration, or would you consider a bearish butterfly with the Dow dropping out? I still like the M3. Going for less money until we get an idea of handling where the market's going. We still have no handle on where this thing's going. So I do think sideways. I don't think any of the trades really are a problem right now. I don't think a bearish butterfly is a problem. I don't think a rock trade is a problem. I do not think a M3 is a problem. The safest trade is probably an M3 trade. And let's see. I think that is all we have for questions. I don't think I have anything else here. Remember, okay, so I think we're all set for the day here. Remember to join me on Thursday at Investor Inspiration. Look for that link, and I look forward to talking to you Thursday and again on next Monday. So have a great week, everybody, and we'll talk to you soon.